Ladies and gentlemen, welcome to a very special episode of the FinTech Frenzy. I ended up missing that episode, so I graciously asked Tim to join me, and I begged him to come on, and then he graciously said yes. That's really how it happened. So Tim, thank you so much for joining me.
No problem.
You had put out a very interesting tweet here. We're not going to go through it word for word, but I can put it up on screen and bear with me a moment. But you had a lot of people very interested in your ideas around SoFi 25 guidance. And this is sort of what the basis of our conversation is going to be about. Ladies and gentlemen, if you guys are not following Tim Sweeney on X, make sure to check him out. I promise you, he is giving more detail, commentary, expertise on SoFi, way more than what I'm doing on X, that's for sure, and covering a lot of great things. So what exactly were you trying to highlight here that maybe people potentially missed whenever looking at management's guidance of essentially like 27 cents?
Well, one of the things you have when you go from a growth company that's had losses to a profitable company is you have kind of an inversion point where you actually have to start paying tax. And because there's differences between generally accepted accounting principles as a GAAP, accounting for your financial statements, and the accounting for your tax purposes.
Sorry, Tim, just one quick second. Your microphone sounds a little bit like it's making a popping noise. Is there any way to adjust that?
Let me see.
Okay. You sounded fine there. I don't know if potentially whenever you moved it, it sounded a little bit better. Try it again.
Is this better now?
Not 100%. Is it just from the laptop or the phone or something?
Is that better now?
No. Is it for everyone else, or is this just for me? Let's double check. I just want to make sure that this isn't just a me problem, because I can definitely listen through it. The people on the other end are usually a little bit more picky than me. But you go ahead and I'll try to figure out. Oh, they're hearing it as well.
What's it sound like?
I don't know. Kind of, it's like the audio is popping. If you have another mic, then try that. If you don't worry about it. I promise you, we can suffer through it if possible. Ladies and gentlemen, though,
is that better at all? No.
No, but it's fine. It's fine.
Okay.
Go ahead and tell us what you saw in the 2025 guidance, because going
back to when we had your last podcast I was on, we were doing the projections. It totally slipped my mind. Something that I had talked about a year and a half ago is like how much net operating loss carryovers they have, because they made a statement they were going to use them up sometime in 2025, I think, as I recall. And so, you start looking at the guidance. So what they're reporting as earnings, and when you have losses, it's very good. And then when you project the earnings going forward, you have to project the taxes that are associated with it, right? So we have an inversion from a growth company where when you have losses, they won't, for accounting purposes, they won't let you take those losses unless and until you know for 50% sure that those can are going to be covered by taxable income later or income later. And so what you have is you accrue that tax benefit, because for tax purposes, it creates a net operating loss, which you can use to offset your income in later periods. But they don't match that with the year of the loss, because they want to be conservative. And by being conservative, they just put it as an asset on your balance sheet for the benefit amount. And then they have an allowance for the equal benefit amount. And then when you actually know that you're going to have enough income to be able to use that, you bleed those allowances into your GAAP income. And they're an adjustment really for a prior period, because you've accumulated all these losses. So theoretically, though, that tax benefit should go with the year of the loss and make your loss lower, but it doesn't. And then at some point in time, once you're confident that you're going to make all that income to use those tax benefits, they put everything in the financial statement. And so what caught me when I was early in the morning was they said that they had allocated all their deferred tax credits to income in the fourth quarter, and that's why they had that 29 cents of income, because it includes about 26 cents of other things and about 23 cents of the deferred tax losses. So they wrote up about $265 million that they had of future tax benefits in that quarter. And that what that really does is it takes them off the balance sheet and it puts them effectively back in all the past periods. But for tax purposes, those NOLs that you can use to offset your taxes go forward. So what I saw when I saw the 27 cents, I said, is that 27 cents is net of tax, right? So people were measuring, and I was measuring, say, what their growth would be. Their growth was, the 15 was like negative 2 cents, I think, for 1 year, and it got to be positive this year, all 4 quarters. So you had a positive year, so you have to pay tax, and then you can use some of those NOLs now for taxable income. But it gets a little bit more complicated than that, because your taxable income for tax purposes is never the same as your basically before tax income for accrual basis, because you have differences in the treatment. So the simple example is like entertainment expenses or fines or penalties. You can deduct those for GAAP purposes, but you can't for tax purposes. So when you can't deduct it for tax purposes, your income is going to be higher earlier, and those are called permanent differences. Then you have certain temporary differences, like depreciation. So like for your accounting GAAP treatment, you might take depreciation over a 30-year period, but for tax purposes, you might take more depreciation up front. So at the end of the period, when you're doing the calculation for the income tax provision for your GAAP, everything else above that is GAAP, and then taxable, it's all taxable. But the income tax provision is a mix between the two. So it basically tries to estimate the actual tax you'll pay on that income, because they'll use their net operating losses to offset some of their taxable income in 2024. So that tax provision that they had, which got them down to the net 15 cents, they had probably used some of their tax provision of their net operating losses. So that number may have been a lot higher. And therefore, in the next year, that 27 cents may be a lot higher too. It could be, because it's very difficult to tell without looking at the income tax provision, because it's hard to estimate from any of the financials whether or not what the tax provisions applied for the past 4 years. So they don't put it in the financials. So I did a way that you can actually estimate it. And I thought of the 23 cents, they probably only have for tax purposes maybe 5 cents left, which is about $50 million of net operating losses that they can use for 2025. But if they do have that, that's roughly 5 cents. So if they get 27 cents, that means they had to have a 34 cents of taxable income. But if they have 5 cent net operating loss credit, it's really 32 cents.
Why would they not put this in their earnings just a little bit more clear? Like maybe an EPS GAAP number as well as an adjusted number for these tax benefits. Well, not tax benefit, but
Well, because just like when I put this out on X and people were reading it, number one, you have to simplify it a lot, because, like I said, I didn't discuss the temporary differences, permanent differences, and how you allocate between the two, or prior year period adjustments, things like that. So it gets a little bit complicated. But I don't think they necessarily ever do it unless you get the income tax provision, and that's really never disclosed in GAAP. It gets because it's a pretty complicated process. In fact, you have teams of accountants and sometimes reviewed by lawyers to do that income tax provision, which is the difference, because you have to show you have to look at all the differences between GAAP and taxable income, and then measure those differences, whether they're permanent and temporary, and take into account all those differences in making that provision. But so for your book purposes for GAAP, all your numbers are all GAAP related on those issues, but then you have to adjust those numbers to some extent to determine what the tax provision is. So the tax provision on GAAP financial statements is really the only provision that marries the tax liability you have, actual tax liability, with your book income. So they just don't disclose that. Like I told somebody on X today, they said, well, why wouldn't they say something about it? I go, well, they were talking about whether the analysts know about this. I go, analysts know about carryover losses, and they probably know about that'll lower your tax liability. But the question I would have asked when they said it was 27 cents, I would say, is that after what's the before tax amount? What's the net operating loss carryover per share that you're using in calculating that amount? Because if they're doing 27 cents, is that after getting a net operating loss benefit, which would make it lower, or is it you have a net operating loss that you didn't consider and that would make it higher? Because you're just usually projecting based on what your taxable income would be less your tax effect. Like they said, it's simple. They did mention that comment. It goes, well, this is after tax. So if it was after tax and it's 27 cents, you can calculate based on their they said a 26% tax rate, but that includes state and local. So you just got to use the 21% federal rate, which means that if they earn 34 cents in income before tax, without just not EBITDA, but just income before tax, then you're really having 27 cents. You really have 34 cents of actual income from your growth compared to your prior periods. So it depends on how they do it and how they do that income tax provision. But my point was, if you're measuring their growth is going to be like 34 cents. That's what they're projecting. But then they're projecting they have to have tax. And so, but it's a natural thing. I mean, it is an accurate thing to do, to be able to look at the after-tax amount, and that should affect the price. But if you think about it, if they're at 27 cents and they actually, that's their guide, and they actually hit 32 or 33 cents, that's actually 38 or 39 cents on a comparable basis. So they're actually projections for 2025 are really not that low, because they're projecting now on an after-tax basis. And the year 2024 has a lot of stuff in it, like the 29 cents adjustment they made. And so you have to sort all that stuff out to see if the growth is slowing down, because my argument was the growth's really not slowing down. And they confirmed that when he said, oh, we're going to hit higher revenue numbers, we're just going to make some more investments. And that's the other thing, is once you become taxable, he probably delayed certain investments because they didn't get a tax benefit for them, and it would create a bigger loss or a lower income, so it'll be less profitability if they've made those investments last year. So you say, why did they put off like level one options? I don't know this, but if it was very substantial cost, if you put it in 2024, it might have caused a loss, right? Or in one of the quarters. So rather than have a loss on the quarters, you delay that to the next year, and you still have profitability. And now that you have greater profitability, your profitability will go down a little bit from what people thought is 30 to 32 cents to the 27 cents after tax, because you're making those investments, and then you're effectively paying for the investments by 21% is being paid for by the taxes you don't have to pay as a result of it. So it's very complicated.
There's a couple things. One, I think you highlighted as well that this could be a year of massive reinvestment, right? Do you think that there's could this fit into a strategy of also a potential acquisition or something like this that they could end up doing in 2025 while they potentially have all these additional benefits as well?
Well, when you make an acquisition, it's not as tax preferable as when you pay for your expenses during the year. Because when you make an acquisition, you have to capitalize that acquisition and what the asset. I mean, depends if you make an asset acquisition or a stock acquisition. I doubt that in a year, if they're really focusing on their own growth, that they're going to make an acquisition. I don't think that would be a wise thing to do unless you get a good deal. I mean, you can always say no, but if you get a really good deal or something that fits in well, and you really need it, or it's really inexpensive versus what you're getting, you're going to make the deal anyway. But,
okay.
But I don't think that they're going to be making any acquisitions. I think they've got their plate full. I think they're going to try to roll out a lot of stuff this year because they have to. But what interested me is that Noto's take on that, by having dealt with a lot of guys in private equity and CEOs, there are a lot of CEOs that could easily hit that $45 number by doing a lot of things. They could just defer the investments to be made in 25, which would jack up their numbers. They could say they want to enter some kind of buyback to reduce dilution and reduce the share count and jack up the price. Then they hit the price the next year, they get their stock, sell some of it or all of it, and then now they're 2 years behind, right? So what Noah's doing is very conservative, but it also is very selfless. Because if you think about it right now, he has a year and 3 months to get to 45 to max out on that. That's going to be very difficult to do, absent a couple things. Ramping up invest and credit cards, and or getting a big tech win, but he'd have to get it like by August, because as they've shown in their announcement that Galileo is going to take time to get revenue 26, that same thing's going to be true if they sign a big bank, because they're going to go through the integration process and the training process. They're not going to get income in 25 from that. But if you do it by August, you could get income in 26 by that, which would affect your projections for 26 in January of 26, and could push the stock to 45 or above.
Well, so I don't know. One of the questions that I have here as well with the 13 months is, I think it's a 30-day period that it needs to be above $45.
It has to be so many days. I think it was so many days within the 30-day period above 45.
So it needs to be in before June. The timeline needs to finish before June.
Right. So I don't recall exactly what it was, but I think it was either 30 days or 60 days. My recollection, it was 60 days, but it could have been 30 days. But it has to be like a certain number of those days. It has to be closed over 45. So
And
that's
they don't need to be consecutive.
Yeah, they don't need to be consecutive. But I'd have to read the provision for sure, but usually it doesn't have to be consecutive. It's the same kind of theory that they have with the converts. They can convert when a certain period of days, if the price reaches a certain level and stays that way or above that for so many days. That might even be consecutively. I think it's more like within 20 days of the 30 days or within 30 days of 40 days. I can't recall exactly what the convertible debt structure was there, but it's similar to that.
Can we try one more thing with the audio, by the way? And you tell me if this is possible, just because I'm seeing a lot of comments about it still. Is there, and I don't know if you're on a laptop or anything, but is there a possible other room that you could try? And I can just remove you from the stage really quick. You can move around your house or whatever, and then I'll bring you back on stage if you're interested in doing that. Well, I don't know if you even care for me to remove you, but
Is this better?
It sounds better so far.
Is this better?
It does sound actually better.
Okay, so let's just do it this way. You're now in my kitchen, so.
Perfect.
Okay, there we go.
Okay, so go ahead and talk for a second.
All right, so what do you want to talk about? Any clicking?
A little bit. Sounds better, but still a little bit. But you know what? We'll deal with it.
Okay, sorry about this. I don't know what that could be unless it's like some buzzing from my refrigerator here.
Yeah, I don't know. I think it might be an internet connection, but I'm not sure. It's just.
Well, my internet was out earlier in the day, so I don't know for sure. I go in my office, which is pretty good, but my office is like secured and soundproof and everything else, and the internet's very difficult to get in there unless I did my laptop. Yeah, so is it any better at all?
Yeah, it is better.
Right. Okay.
So let's talk a little bit really quickly. Actually, there was a super chat here, so let's just field this question really quick. If SoFi is projecting 55 to 80 cents by the end of 2026, what should we expect for EPS in each quarter of 2026? I don't know if
that's impossible to say. That's really impossible to say.
That being said, what did you think about Q4 numbers in general? Like, did you end up getting to see the member growth and everything? What were your initial thoughts?
Funny thing is, when you guys were doing your guesses, and you already had 4, 8, 9 or 10 weeks of data out of 12 or whatever it was, I did the actual calculation, and if you just base it on the number of days left versus the number of days they used. It was actually the 785,000 right on the button. So that's interesting. I think their member growth is good. They have a lot of people don't realize it's still like a startup company to some extent. They have certain mature groups like lending, and now the loan platform business is kicking off, but it's only been here since third quarter. They have student loans, but they've been hurt by the forgiveness. They have mortgages have been hurt by interest rates, and so they're still all coming together. And when you think about that, they've been coming together, and they have like a quarter of maybe coming together in interest rates, and interest rates aren't low enough for mortgages. There's still a lot of catalysts they have, and so I think their numbers were actually really pretty good. I think the only thing that if their guidance would have been 38 cents and everything else was the same, people would have a complete change of opinion. Or even it was like 32 cents. But if you take 32 cents, it's 5 cents, right? So that's like $50 million. Out of a multi-billion dollar company, that's not a lot, but it moved the stock way more than 50 million. So the 1 or 2 cents differences don't really make that much difference in the long run, but the stock price reacts pretty violently when you miss those things. And that's the same thing with Nvidia. That's a pretty big, substantial drop when you consider stuff, because you really don't know if any of it's true, or to what extent it's true, or to what extent that they used Nvidia processors bought through Singapore or whatever. But you really don't know. So, but if it's 1 cent off here or 1 cent off there, the theory and the prognosis of the company is still pretty good. What was wrong with the earnings? Tech is slow, but tech's going to be slow. It's a disappointment, that they haven't signed a big bank, but those big banks are going to be a little bit weary until they get more people on their platform. You might want to try to get a couple more regional banks in the interim and give them a really good deal, because you're going to make more money on the big banks if you get them. But those guys know what they're doing. They're in Galileo and Technisys, and I would bet they're doing the best they can. But it really takes a long time to sign up somebody, and they haven't nobody said no yet. I'm assuming that, knowing the process, that people don't want to. They're going to hold off as long as possible, as long as their systems work. I was in a company that we actually did that. We just said, we'll just hold off as long as it works, because there's a lot of training time, there's a lot of integration time, and there's a lot of things that you think possibly could go wrong because of adopting a new system. And so you kind of wait till you have to do it sometimes. And I think there's a couple banks that are pretty close to having to do it.
Yeah, I like that. It's clear that these larger institutions cannot do this all in one step. And so if you follow the Galileo marketing, they've been pushing this idea of slowly migrating, do pieces of your business at a time, because they need to start really addressing the problems of these larger banks, which I'm sure is these sort of aspects, is what to transfer over, what are they going to start working on first, and they're kind of having troubles with making this decision, I think. And I think Noto and team are a little bit blown away by how slow they actually work, which, to be honest, kind of goes to the benefits of SoFi and fintechs in general, because they're blown away by how slow these financial institutions are making their decisions. That's probably why they were off on their guide so much. They didn't know that they would be this slow.
Yeah, I'm not so sure that Noto thinks that 25, 27 cents that he was off on the guide, except he's lower than the street. But if you think about it, I think if I had to answer that question for him and my life depended on it, I would bet anything that, they deferred some of the investments because they wanted to maintain and enhance profitability 4 quarters in a row and get to the point where their profitability was much higher. Because, for example, investing in credit cards, I've been a big proponent of doing things with credit cards, but what I suggested to do might have cost them $60 or $70 million in 2 quarters. And so that'd be 3 cents a quarter. And one of the, in 3 of those quarters where I was mentioning that would have caused a loss. And so you can imagine if they had a 2 cent gain versus a 3-cent loss after having 2/4 of 1 cent and 2 cents. So that's kind of a smart thing not to do. I mean, it delays kind of the credit card profitability coming in and adding later, but you have to have a consistent ramp because people, when you're a private company, you'd never do that. You'd invest it as soon as possible and get the ball rolling as soon as possible, and getting the credit cards or whatever new business out there, and you'd spend the money because although you're accountable to private equity or your owners, they realize that you got to spend money to make money. Whenever you're dealing with a public company, as you can see on X, every shareholder has an opinion. Every analyst has an opinion. You know, if some analyst doesn't like you and says they don't think you're doing the right thing, or shareholders complain, or you have a loss in the middle of after 3 profitability quarters, your tank's going to stop. Your stock's going to tank. Then where are you with regard to getting the earnouts on the PSUs, right, on those options? So he did the right thing and the smart thing, but I think he delayed some of the stuff because it might have been expensive, and now he has enough profitability, and now that he has the wind in his back, it's like, you're playing a football game, since Noto likes football. He's playing the first half against the wind, right? So he doesn't know what's going to do. He can't sail the ball. So now the second half, he has he has the wind with him, and so now he can let loose the offense. And I think he's letting loose the offense not by just saying I'm going to do X, Y, and Z, but actually doing it. And he knows it takes an investment, and he knows he's going to spend some money to get those things up and running. So I was thinking about like level 1 options and what that would have cost. And I thought, people simplify, go, okay, I can buy options and I can sell options. That's just a trading mechanism. But when you have the ability to sell covered calls and sell puts, you're also then engaging in spreads, and how do you fill those spreads? Because you want to fill them on a joint basis, so somebody can go, I want this with this spread. And when you do that, that's a lot more complicated. I believe it's a lot more complicated engineering to get that done. It's a lot more costly to have that kind of system or build that kind of system. So I'm sure that they were working on it, but now they can work on it because they have extra money. When you ever have more profitability, you can work on it. And so I think what Noto is actually saying is, now that we have consistent profitability, we're going to be profitable now, in the long run, and extremely profitable, and we're ramping up everything. Now we can invest in other businesses and ramp it up faster. It's the right thing to do. Now, shareholders aren't going to like it. The street doesn't like it, because the street is let's get to now 45. But if you get the stock to 45 in March, there'd be a lot of people selling, and then the stock would drop. So you really want a stock that grows consistently, that has some fluctuation on the margin between with the price high and low. You don't want a stock to go to 45 down to 25, up to 40 down to 10, because you're going to lose a lot of investors. And if you're a CEO and you're responsible, and you appreciate your investors, you're not going to want to kick your investors out and hurt them. So a guy invests at 20 and then he sells it at 10, then it goes back to 20 and he buys it again, it goes down to 15. You want a kind of a steady, gradual growth of the share price. And I think Noto clearly wants that, because he supported the share price with multi-million-dollar buys of stock, because he was confident that the time would come in 6 months, a year, or a year and a half, and the time has come, right? Nobody would think right now that the stock's ever going to go back to $6, but people a year ago thought it would go to $2 or $4. So
crazy, eh?
But if you think about it, you think of where SoFi is now versus when it was November 21, when it was like $23. There were like analysts back then say it's going to $30. And if you looked at this company compared to that company side by side at the time, if that was 21, this was like 65, right? So you got to look at how the business develops, not how the price of the stock develops. And so when you're like, I had some NVIDIA that I sold last May, and it was like, I bought it like in mid 2000s, and I think I forgot what it was, 10 or 20, $15,000, something like that. And it was like hugely up. And the reason I didn't even worry about it was not that much part of my portfolio, it was part of my trust. And I was like, I just never looked at it. And I looked at it, I go, once I looked at it, it was like 150,000. Then I worked at it, it was like more. And I go, oh, I don't know how long this will last. But I didn't have that much into it. So I just said, you know what? It seems like the demand keeps going up. I'm just not going to look at it. And I think for a majority of the shareholders, at some point, you got to kind of trust Noto and the team and not look at the stock price every day. It would be beneficial to a lot of people. I look at it just because I have nothing to do. I'm taking care of my son, and he's like started to go to sleep or whatever. And I got my phone, and I'm just looking at it and writing stuff on X that I thought was like a page long, and it turns out to be like 6 pages or 8 pages or something. But you got to give them credit for everything they faced and came out relatively quickly, right? Relatively quickly from the time they got the student loan forgiveness, took their basic business away, and they basically went on to focus on lending, now focus on the loan platform business, and they have a ton of other things they can do, and now they have the profitability to be able to do it and engage in it. And so you have to give them a little bit of string, a little bit, loosen the strings a little bit on your thought process and what they should do. Because everybody has an opinion of what they should do. I mean, I'm the first person. I have opinions on what they should do. I always put them on X. But, they have way more information, and you just got to watch. Are you happy with what's going on? I mean, and you can't judge your happiness by, I thought the stock would be 45 and it's not going to be 45. He's just shown you by saying he's going to invest in this year that he's probably willing to give up 1.2 million of those shares, because he might not hit 45, and so he's given up 1 million shares if he's given up 1.2 million shares for the long-term prospects of this company, and he has millions of shares. 1 million shares is $20 million. He's willing to give that up. He's given that up so shareholders can have a conservatively growing base, and so. I don't know if he gets to the 45. There's a lot of things he could do to get to the 45. A lot of things have to. It's a tall order. It's a tall order of 45. I think 35 is pretty easy. I think 45 for that period of time before June, that's kind of tougher.
You know what? I think, I mean, including the 60 days that it has to hit, it's definitely going to be really hard, in my opinion. But and we also have to remember, like these timelines were set quite a long time ago, way before what happened in the macro. We knew it was going to happen. So it was so many more headwinds than what they were expecting. So that being said, though, the fact that they are not focused on quarter to quarter growth, and they do still see that there are going to be these years where overall GAAP EPS will be lower than expectations, but potential investment or growth will be higher than expectations. I'm a super fan of that. Some of the best companies I've ever held have been the ones that have focused on the decades and not the quarters.
It's like people that focus are extremely high focused on the 27-cent guide. I'll call it the 25-cent, 27. But I'd say it's a 27-cent guide. You don't recall that they beat last year's annual guide by what, 60%? You forget that this is who they are, right? This is who they are. They're going to guide so they get the guides, and they're not like holding back. They're going to hit bigger numbers every quarter. And, some people can say, and I think it's a legitimate criticism to some extent, that he's way too conservative in his guides, but he had to be in last year because of profitability, right? He had to hit those guides, and he had to hit that profitability. And this year, basically what he's saying is, the street has me at 29. I'm going to say 27 because I'm going to make all these investments, and it's going to be an after-tax amount, so it's really higher anyway. But I'm going to do what I need to do to grow the business, not what I need to do to get the stock price up. And that I think that affects people, because there's a lot of traders. There's a lot of people that say they're long-term holders, but they say, hey, if it gets to 25, I'm selling, right? So I'm kind of not buying I'm a long-term holder, I'm going to wait 10 years, but they're complaining that it's not 25 right now instead of 16. Because what happens when I've been around long enough and have enough stock that it's like it doesn't do anything. It doesn't. I mean, Nvidia, when I first had it, didn't go up for like 4 or 5 years at all. I think it was like I go, why did I buy this dog crap? But it's like I held it on for like 20 years, right? And so it's the same thing is true with a lot of companies that especially growth companies. You got to wait till the analysts catch up with the growth, and I've done several posts that say they don't measure growth appropriately, like by using tangible book value, it's true. They don't measure growth at all. That's the average growth of every major mature bank. And your growth is 30% higher than 30% is 20% higher than American Express. It's 19% higher than Bank of America. And if you look at 19% and 19% and 19%, that's a pretty big gap. It's like the compounding of those 30% is going to be huge, but it's not going to be huge day one. It's only going to be 30%. So if you say next year it's going to go up 30%, so the stock is at 16 and it's going to go up 30%, so it's going to go to 20. And then next year it's going to go up 30%, it's going to go to 26. And if I told you that you could buy a stock when you were 27 years old to keep it in 20 years, it'll go 30% up 30% per year, I guarantee you I'd tell you to put all your money into it.
Yeah.
Right?
100%.
But people, it's gone up 100 and some percent, and they're like, well, it should have gone up 300%. And that's part of the mentality that I saw back in 2000, right? So navigating 2000 is kind of like navigating today. A lot of people that invested, a lot of younger people, they've only known really a bull market. They've had some corrections here and there, but they've never known a 2008 wipeout or a 2000 wipeout, what you have to do and stay in the stuff. And so they're eager to get those gains because it's just like gambling. It seems like it's free money, and every time you gamble, you want more. And you got to step back and look at this like it's a business you're buying and participating in. That's why I comment on it, because I look at it like it's a business I'm participating in. And to some extent, X allows you and YouTube allows you, and having guys like you do channels that focus on this allows a person to be way more educated about stuff. So that's most of my posts. I said this is for educational purposes. And the post I did on the deferred taxes the other day, that's a very sophisticated concept, right? It's a concept when I was teaching accounting at University of Michigan and finance at University of Michigan, you wouldn't get that until like the third or fourth class, and maybe a tax class and an auditing class. And even in doing it where you have permanent differences and temporary differences and how to do your tax provision, you really don't even learn that in graduate school, right? So I was trying to simplify it so people could understand the concept. And the concept, my whole point wasn't that, it's going to be 50 cents and the stock should be $100. My concept is the growth is intact. In fact, it's still growing at a good clip. And when you have something that's still growing, in the interim, if it's a penny off is $10 million. It's nothing in the scheme of things. And so, but that $10 million off one penny, like maybe Lending Club, I don't know what it was off, but it could take you down like 200, 300 million because you missed by a penny. But when somebody tells you, like Noto, that this is 27 cents, we're going to make more investments, it's after tax, and now we're a taxpayer, so we're going to have to do this. So you have that one inversion point. That one inversion point going from non-tax entity to a taxed entity, and you got to get over that one period, and that one period now is going to be 2025.
But also, that's what SoFi is also guiding for in Q4 of 2024 for the end of Q4 of 2025. When have they ever been accurate on that number in any other time? So even if they're saying, this future investment, it might be a little bit shy on these numbers, I don't even believe them. They've been far more bullish on their actual numbers than what their assumptions were.
Yeah, I think that's a legitimate criticism, because I think what was the last year he was aiming for 9 cents and got 15, or 8 cents and got 15 at the beginning of the year.
7 to 8, and they got 15.
He could have said 12 and he got to 15. You'd still get a hero's welcome. So there's a fine line between that, but you have to notice in like dealing with CEOs and different CEOs' personalities, do you want a guy that's going to say it's 15 and get you 12, or you want a guy that's going to say it's 8 and get you 15? I mean, he's not suckering people in with like false promises. He's actually doing the opposite. He's being very conservative. But that's what my point is. Like a lot of CEOs, that's who they are, right? And you're never going to change who they are. I mean, I'm a really conservative guy too, and people think I'm too conservative. And I had a similar background to Noto. As growing up, I didn't really have much. And when you don't have much, you protect everything you have. And so that's going to be his mentality. And when he says, like when I played sports, it was defense, and then I'd ramp up offense after we knew we had them held on defense, and then we take some more chances. That's the mentality from growing up that way to some extent. A lot of people have that who are successful have that mentality. There's a lot of CEOs I know and very few of them came from wealthy families, because they couldn't just like spend money and go get more money from dad. So you had to be really conservative with your money and conservative with your thought. And it's worked for him his whole career, and you can't expect him to change it now. But you can. It is a legitimate criticism from an outside party to say, I think it's about time to get closer to what actual numbers are. But
yeah,
that's who he is.
I would like to change some of the ways that they end up doing it, but you cannot fault the actual outcome.
Right.
What they're able to deliver is incredible. And that's what I think a lot of people are, especially the short-term minded traders, are getting wrong, is that they see that the stock went down and they're making assumptions that things were worse than they actually were. Q4 was a beautiful quarter.
It was a very good quarter.
Yeah. It's the same as every other SoFi quarter, above and beyond expectations, all across the board. It was great, but a lot of people did not like the guide. And this is why I think you're getting so much traction on your tweet, is because you're clearing up a lot of the, potential misunderstandings for this.
Yeah, that's what my purpose was, because I literally I was out with my son, and because he was asleep, and I was getting stuff ready for him, and I was tweeting on my phone to some extent. It's when I saw that, I actually on our X private chat, I said, somebody tell these guys that that's tax affected. That's 34 cents, not that. And I think Chris Hager brought it up. Because it makes a big difference when you're thinking about that, because really, you have to pay your taxes, and his guide is lower. But what was his revenue guide? All right, how much money are they going to make? Because if you're starting a business, and I said, for the next couple of years, we're going to grow our business, and I'm not going to pay any taxes. You go, hey, that's a pretty good deal. How much, especially if you're growing your revenue, right? You want to grow your revenue, you get your revenue up 10, 20%, and if you have to invest, you invest for the future. This company is not anywhere near where it could be, right? I mean, it could be expanding tremendously in, like they say that crypto-based trading, then they have crypto-based custody, and then crypto asset-backed lending. Well, if they're going to do asset-backed lending, they can do asset-backed lending for a lot of things, for small businesses. There's so much that they don't do, even as a bank and even as a tech company, because they're on the lower end, 1 to 2 out of 10 on their growth scale. And you want to hold the 1 to 2 out of the 10 on a growth scale to get it to 10. And so, I have a big position, and my position, I'm never going to sell the stock and spend the money on myself. It's all going to be for my kids. But my plan is that I'll have that bit of stock. They'll create some dividend, and that will give them yearly income, and they might take a little bit more out of here or there. And I have other, assets too. But I'm not oh my gosh, I got to get a Lambo.
Right.
But I understand the joke, right? I mean, I don't know how much the Lambos cost, but there's a lot of people that have made a number of Lambos already, because they saw the potential for success at 4, 5, and 6. Even when they bought originally at 15 or 18, at 4, 5, or 6, they doubled up, tripled it, put a lot of money down, and those people held on. And so part of my goal on X is to educate people so they don't get thrown off there, because there's a lot of people. I'm totally surprised on X when I see the comments to my post and ask people if they understand it, and then talk to them, as a reply and a response, that how well they can get educated on this stuff fairly quickly, and it's very sophisticated stuff, right? My last post is very sophisticated, but people understand the gist of it, right? They understand, oh well, the tax effect, so they're going to be they're still growing, but they're going to have to pay tax. I get it, and it's a complex accounting thing, complex tax thing. And I might not understand all of it, might give me a headache to try to go through all of it. But I simplified it enough that you could basically understand it. Even if you didn't have a college education, you kind of understand it. And so that was my goal back when it was 4 to 6. I said, there's a lot of callous here. There's a lot of things that can make this company really well. And the misinformation was all coming on the sell side, right? Just think of all the things that they said, that have been debunked over the last year and a half of all the bear arguments. They're all gone. right?
Over and
And now with
over
the
and
loan
over.
platform business, it's gone for good, right? So like, okay, well, the fair value is an issue. And what Noto say? We'll do everything in the loan platform business, right?
Crazy.
So where's that as an issue? And then you still have analysts go, well, they have a fair value problem. I go, what are you doing?
Yeah.
Right?
They're selling loans. So does BlackRock not see the misvalued loans here, and PGIM and all these guys are not doing their research and they're buying these crappy loans? Yeah, right.
Yeah, Wall Street's a game. It's a tough game because if you have any experience with Wall Street, there's some good guys in Wall Street and there's some bad guys. But I had a conversation with a private equity guy once, and it was about like a business they were doing. And I said I wouldn't be in that business because, you're really just splitting. You're almost defrauding these people and splitting, taking their money away. And he literally told me, if they're stupid enough to give me their money, they shouldn't have the money. I mean, so when you're buying stock in that, and if you're saying I want to compete with the traders on Wall Street, you really can't compete, right? You when you're buying these short-term options like a week or two, you're better off like people are to sell the options and buy them because you don't know what's going to happen. Now that's not like a 2-year leap or something like that. That's okay, but I don't even buy those. I just buy the stock. I remember when the stock was $5. I go, I can buy a leap for $1.50. I can buy the stock for $5 or whatever. I said I just rather buy the stock, and then not worry about it. It's paid for, and I don't have to worry about all the deltas and all the Greek letters. I don't have to worry about any of the Greek letters. Yeah. So, and the degradation over time, but I think they have more potential businesses in front of them by a factor of 2 or 3 or more than they have businesses now. And they're going to push it, and those going to take time to invest in those businesses, have them mature. And you can't do you're not going to do all 5 things at once because you're going to be you don't have enough employees to do that. You can't apply employees faster. The good thing about the stock re-rating and getting higher is now it's easier to get employees because they see the potential better. People really they have it backwards. They don't see the potential at 450. They see the potential at 20. So but having been an employee that had stock options and that were like up high and down low, it's like you're like, I spent 2 or 3 years and my stock options aren't worth anything. And when they finally start moving, the atmosphere and the motivation of everybody goes up pretty substantially. So
I got a couple of comments in the chat here, so let's go through some of them.
Okay.
George here has been a member for 19 months. Oh my God, George. Okay. Excellent conversation, Tim and Tanner. What do you guys believe will be the next new product SoFi will likely bring to market to drive growth? What do you think, Tim?
Well, to drive growth and members or revenue or I think they're working on credit cards that can really drive growth. But I think in the interim, level 1 options plus crypto could drive growth too. So it's the question of what kind of growth you want. But I just think they're going to be working on several things this year, and they're going to be working on tech, try to get a tech sale. They're going to be working on crypto trading, probably at least. They'll probably get the crypto trading going. And then the small business loans was an interesting thing that he mentioned. They're getting into small business loans. It didn't say small business accounts, but that's a big thing. So I think like for small business, I think they're moving to the small business loans first because it's easier, and then the small business accounts come after. People think small business accounts are going to be easier, but there's a lot of issues with small business accounts, and how you hook up the accounts with Quicken, how you connect your accounts with ADP, and you have payroll and all these other issues that you don't have really in a personal checking account. And I realize people say, a small business, I can use a personal checking account for my small business. And I actually have 2 small businesses, and one's smaller than the other, and I use a personal checking account for that business. But my other business has so many employees and stuff that I have to, there's a lot of, I need a small business account that basically is coordinated with ADP and my workers' comp insurance and everything else, and that takes a lot more than just saying I'm going to open a bank account. But small business loans could be a big deal. Crypto could be a big deal to some extent. I think I think the focus, and I hate to beat a dead horse like I always do, but I think to get credit cards right, it's a lot of money. It's just a lot of money.
You've been on it for a while, but you know what?
Yeah.
You're right. But did you see the amount of credit cards they added this time? I
Yeah.
think it was quite the ramp up.
Yeah. Was it
Let's
14%?
take a look at that. Here, let's take a look. Let me share my screen really quick. It looks like an increase back to. I'll zoom this in for you and for the rest of the audience. So obviously they've done quarters. This is all the way back in 2020. 20,000 plus credit cards. But then in Q4 of 2023, there was a real change in strategy down to single digit thousands for then a full year up until this most recent quarter, back to 14,400 new cards. It looks like back to re-acceleration more, 10,000 more than what they did the quarter before.
Yeah, I don't know the terms of their everyday credit card really that well, and who they're targeting. But I think it's a good thing to do. But this is the same conservatism, right? He's going slowly on credit cards because you can lose a lot of money on credit cards. That's why when I suggested my everyday card be a secured card, which they can do through Galileo already. So, and he said they're gonna do more integration with Galileo. You don't lose any money on secured credit cards, right? And you get 3-5 times the interchange. And the problem is how do you sell it to people? Because some people go, I don't want a secured credit card. Why should I be secured? You don't trust me my credit. That's a legitimate comment. But the idea of every college person going away, getting a student loan from them, and instead of giving them $300 off on the loan, you give them $300 in their secured vault for their credit card, and it's a regular credit card, but it's a $300 limit, and if you don't pay it, whatever you don't pay is subtracted from your limit. You just sold four products: a checking account, a savings account, a student loan, and a credit card. And those people can get some kind of benefits and rewards that they're not getting on their debit cards. And they'll appreciate that. And you can actually then train them through the use of that card to get in to be better credit-worthy people. Because most people who are not credit-worthy just don't know how to use credit. And some of those people don't know how to use credit, and they don't ever want to learn how to use credit because they just think it's free money. Then other people just get trapped in it. But
I think you're 100% right on the secured card. And what's weird is that they'll promote other financial institutions' secured cards if they do not accept you for a real card. Like this is what they do. If they don't, they'll promote Chime secured card. They'll make a referral fee, but I find it would just be much more advantageous for them to just make that interchange themselves and keep the client on your platform.
Yeah, but they have there's a couple problems with it that I've thought about. One is they want to focus on high earners and have a certain level of high earners as their members, and that's a good selling point and a good marketing point. And so if you're getting somebody that's just going to use their debit card and their FICO scores are different, you have a FICO score that's 400 and you have a secured credit card. But when they put their credit card numbers out, their average FICO scores are going to be lower because of that. So that might be one reason they're avoiding that. The other reason they might be avoiding it is you get credit card. You hire the best credit card people that used to come from J.P. Morgan, and they try to say, "Oh, we're successful there, and here's what we did there, and we'll do this here." And they have this new card with Galileo is partnering with a hotel as a debit card or a credit card. I think it's a debit card, but you're not going to The reason J.P. Morgan makes so much money on their credit cards is they partner with other people, and the rewards that you're giving as a bank, they're getting their partners to give. Like American Airlines gives you those points. They'll pay for some. It's split between them, so they don't have to pay the full cost of getting that card holder. And so that's kind of hard to compete because you're going to come in there and say, "I'm SoFi Bank, and we want a travel card that goes to this hotel or that hotel." You can see how J.P. Morgan did it. So you're actually bound in a box by the people you hire's success in the prior thing without being able to look forward. Is my personal opinion. And so it's like why wouldn't you have a lower interest rate credit card? Because it looks like everybody wants it, and you wait till it's required, and maybe it's never required. So that's a fair point. But if you're the first to do it, it might not be required. And if you can figure out how to make money because your card's secured and you have a 10% or 8%, whatever, on a secured card, they're not making 8% on their credit cards now. But your problem is you don't have those high earner people. So you want to give that to everybody. I mean, you could effectively give a credit card to 8 million members and give them benefits that they go to your bank, but they wouldn't be high earner people. It'll affect your numbers. And I think so it affects your marketing. So I think that's the reason that they'll wait to do that. But I think once they get more mature, and at some point, your horizontal market for high earners gets reduced, right? When you get bigger and bigger and bigger. And but you're not there with credit cards yet because you have so many people that are high earners that have a lot of credit cards, and then they'll get personal loans. So there's some validity to the argument that we'll give them credit cards at 28%, and then we'll offer them a personal loan to help them out. Well, you can have your own people have credit cards at 10%. Figure out a way to do that in part of an ecosystem where they're investing in, they have money in invest, they have money in savings, they have, you get an overall return from your customer. Kind of like you don't have to have as high. I mean, Visa doesn't get 3% on every transaction. They get a really partial percentage of 1%, but they get a lot of transactions. So at some point, somebody's going to realize that that's probably a better model, but I don't think they can probably go there. Even though it's my idea, I don't think that they can do that right now. And so they're focusing on just building up the ecosystem with the people they have.
Going back to the question of which products do you think will lead to potential future growth? I think you read in that chat that we're both in of this potential new product that they're working on for personal loans, the direct pay product.
Right. Yeah.
You had some thoughts about this.
Yeah.
I'd love to know. So one, just to give some people some, understanding here, and I'm going to cover it more tomorrow as well. But there's this that was ended up found by one of the people that cover SoFi very, very deeply. It was actually Vadim. And essentially what this is that it's a personal loan that you can end up taking out. And instead of just taking that money out, bringing that cash to your account, and then paying a credit card bill off, what SoFi will end up doing is pay that credit card bill for you directly. And it got a lot of SoFi investors to sort of think today. I'm curious on your thoughts, Tim. Is this important ad, and does this potentially increase the total addressable market for personal loans like the way that I think it does? Because to me, this feels like a really easy way to help with debt consolidation.
Yeah. It can pay them off directly and can pay other bills off directly. I view this as, because I'm a long-term proponent that they have an ecosystem with credit cards that lead you to invest, that lead you to get like wealth management type tools. And that's a typical wealth management tool. So if you have a wealth management, you can either do it through your bank or through Goldman Sachs, or what they do is they don't want to take their investable assets out, so they take loans to pay their stuff. And then when so they'll take a loan, and they'll have, like, their family office will have the bank pay X, Y, and Z out of a loan provision. It's like a revolving line of credit for a company, right? So you can have a revolving line of credit with the company. You can take that amount and pay it directly. Because you can have the bank pay it directly now. It just builds up your revolver, and then once a month you review either the family office statement or the bank statement if they're doing it for you to make those payments, and you say, okay, those are okay, and you make one payment of the full amount to your loan account to zero it out. Or you can keep that in a loan with an interest balance, because you don't want to sell your XYZ stock and have to pay tax on it, right? So that's a typical wealth management family office kind of functionality, where they have a revolving line of credit to live on and pay their bills. And paying them directly allows the bank to have more stickiness, because they'll keep all that data for you to pay that, and you can pay them directly rather than you having to pay the check. You won't have to pay the check, and so we'll just fund that loan account. The only thing you have to do is review it every month and pay down on the loan if you want to if you want it to accrue interest, or you can pay it off every month. And I think it's going to be more like a revolving line of credit, but I don't know because there's not enough details on it yet. But that would be my idea of what it looks like it could be.
Yeah. And what about your opinions of Cash Coach? This is another product that should be right around the corner, helping people understand where they should put their money. Really, probably the most important product of getting your money right that should be coming out soon.
Right, and that to me actually goes well with credit cards, because part of they say is what credit cards and stuff should you pay? Well, what should you do? And number one is an aggregation of data, right? You want to aggregate all their debt data of what debts they have, so that the Cash Coach can tell you what to pay. But it can also save you a ton of money, right? Because you put in one time what the and I don't know if they can pull that stuff from knowing where your payments are, what your debt interest rates or whatever. But they can say, even if you input at one time, the Cash Coach will say, pay this off, pay that off, pay that off. And that's a little bit of AI involved in that. But it will help people learn how to manage their resources effectively and manage their debts effectively. And to me, that's kind of good. I think that in the long run, what I liked about SoFi is the get your money right thing, right? Because so many people don't get their money right, and they have credit card balances when they don't have to have them, or they'll have a credit card that has 28% and they won't even go get a 0% credit card. They go, well, it's going to cost me 5% to transfer it over. I go, yeah, it's 5% for the year, and you're paying 28% for the year. It doesn't make any sense. And people don't have the sophistication to understand that. And it's something like Cash Coach can tell them that. But I'd really like to have a credit card system where when you tell them that their 28% credit card is no good, and you get a personal loan for 10 or 12% or 9%, and then get a personal loan that will pay that off, and then Cash Coach will tell you when to pay your personal loan, how much, and when to pay all the other debts, and it will help not only them get their money right and pay their debts. It'll also help SoFi, because these people won't default as much because they're learning how to manage their credit. And so I think that idea is a super idea, and how you integrate that in the ecosystem is I think the important part of it.
Yeah.
And the more data, of course, the more data they have, the better they can serve you, right?
Any last thoughts, Tim, before we wrap up this episode?
No, I just think, I think if people don't understand, what we were talking about the tax and the tax provisions and the deferred tax credits, I think that they're better off to read the post, because they can take their time, go paragraph by paragraph, and understand it. It's a lot harder to understand it when you explain it to somebody. And I wrote it so I could simplify it as much as possible. It took me a while to simplify it, so I'm never going to talk on it as simple or as it would be able to be if you read it and understood it that way.
Right. Ladies and gentlemen, you can go find this at X. I can also pull it up here. He has his X right there on screen. Just, I don't know if you guys can see it right there. So it'll be, I think the top post on your.
Sorry, it's like 60, 70,000 or something, 65,000 views.
Yeah, and honestly, you broke this down in such a great way. This is not something that I'm too privy to and think a lot of is tax implications to this degree. So this was a great explanation. I really do appreciate you coming on. I feel bad that we couldn't figure out the audio situation too much sooner, but it ended up getting solved and sounds a lot better near the halfway mark of the show. But
the caveat I would make on that is that we don't really know what their tax provision was. They could have used up their entire net operating loss in 2024, because the difference in permanent differences and temporary differences, the differences between your GAAP accounting and your tax accounting are so substantial sometimes that they could have been paying federal tax last year, or they could have not had their income would have been much lower for federal or for GAAP purposes on different items that you don't really know unless you look at the tax provisions. So, but that was my best guess based on what I reviewed the financial statements, that at some point 23 and 24 they had about 50 million or 5 cents a share that they NOLs that could carry over. But I could be completely wrong on that. But like I said in the beginning, I'm using these numbers. They're directionally accurate. but I don't have access to all the numbers to be able to give you a fine-tuned number.
Right, right. And by the way,
But
nor do we even have access to the 10K yet. So we'll even have a lot more information on SoFi's overall quarter, let alone what they are guiding for in
yeah,
probably a couple weeks. So that'll give us a lot more information about the company as well.
yeah, and I just think that they when they're telling you their revenue is going to be 10% higher than they thought it was going to be, and they're going to make investments, I think they're telling you that the growth is there. And so I'm not worried about them spending money on investments to make more money. I mean, if they came out and said, we're not going to make investments, we're not going to do credit cards, we're not going to do crypto, we're not going to do this, the stock would have sank completely. So if you're going to do that, you have to understand that those are going to be investments, and it could take time to mature those businesses and get that revenue, similar to what they said about Galileo. And so I view that as a positive, not a negative. They're investing, especially if their revenue is growing, because that means they're paying for it as they go. They're not borrowing money to get it, right? The only issues I see at SoFi really is how they manage future dilution and when they can pay for their own stock-based compensation. That's really the only argument you really have, and it's falling dramatically. And the higher the stock price, the less stock they actually have to give to some extent. So I'm watching. I'm not 100%. Like I said, I said last March it would be 7 to 9 for 6 months. So I'm not like a raging bull about it, but I'm rational about it, I think. And I think getting information from you guys, like in all the shows, you and Tevis and Roy and Brad and a lot of the people that give information, that's how I rely on it, because I don't have to go look at it and myself. I could just like watch one of your podcasts and look at it, and it's like it's a big service for everybody. So I encourage people to join your groups and watch your podcasts and stuff like that to be educated.
And
I
that
don't have the
goes out
time
to
to do
Brad
it.
as well. A lot of people on the
Yeah,
YouTube channel don't know Brad very well because he's on X, but
yeah.
you should come on the stream sometime. We've had him on the SoFi Weekly only once, but
Oh,
another amazing voice for the SoFi community. So
yeah. Brad's a fellow U of M graduate, so I have to support him.
yeah, yeah. No, you know what? What's interesting, I want to wrap, but there's so many interesting things that I want to talk about whenever you're here. So
Okay.
like even the revenue was higher than what Wall Street was guiding for. I think it came in at 32 3.2 billion for 2025. What do you actually think the year is going to finish at? Do you have any expectations for full year revenue? Because
Well,
I'll be honest with you, I think we get to 3.6.
I think it depends on the macro, and contrary to what people think, like there's a Fed meeting and they're probably not going to raise. I don't think that 3 rate cuts is better than 2 for SoFi. I really don't. I think they need to be spaced out, because you don't want to have, whenever you have to give time to your selling stuff, and then the anticipation of the rates going lower lets you sell more stuff. And when the rates seem to be bottoming out, that's when the time that you might lose some demand for your product, because then they think rates are going to go up, right? But they'll always have demand for their product, because the term of their products are relatively short, right? So if you have those personal loans for like a 1 to 1.5 to 2 years, you don't get a huge loss when interest rates gradually go up. And so likely the rates will go down and stay there for a while, but you really make money on doing the loans at 2% and then selling them. I mean, say it's 5%. If you do the loans at 5%, and then when it gets to 3%, you sell them because you get a much higher premium. So I think their revenue, if there's what they project is 1.5, I think it's going to be 2, maybe 3 in the later half at the most. But if they have one in like June and one in September, I think that's ideal for them, actually,
You know
as
what? I
opposed
think
to
that's
3.
such a great point. Not many people bring up, and it happens in the buy now, pay later space as well. Everyone thinks that rates are ultra effective on these companies, but a lot of the times their loans are so short, duration, that the rates barely even affect the pricing of the sale of the loan, because, well,
Yeah,
the rate doesn't even affect a large majority of the actual loans that are written. So
right.
um, it
So
does
it's
have a
it's
less of effect than a mortgage company or something like this.
the answer is, I think you're probably more accurate than the 3.2 guide. I think it's probably going to be 10% higher than that, because I think there's a lot of stuff. There's a lot of revenue they have out there that they can make. Because you're talking about revenue, right? You know, because you could have like a 10 or 15 cent bump in revenue and have your expenses go higher and only get like a 5% bump in net income. But I think their 27 cents is low. I think on an after-tax basis, I still think they'll get still think they'll get in the, between 30 and 35 cents after tax. So about,
I think they're low across
30,
the board.
Yeah, but you have to understand is what people don't realize is they're comparing it with like the lost past periods. When they said 50 to 80, I don't think many people, you might have realized it but not thought about it, that 50 to 80 means 70 to $1 in earnings pre-tax, just pre-tax, not EBITDA, but just pre-tax. That's the I told you back to get $1 a share and then you'd pay tax back then, you'd say that's ridiculous. That's really substantial growth. You know, it's $1 billion of net income.
Yeah.
Before tax. And
especially
so it's
with
like
the amount they're diluting. I always need to reaffirm people, like, you know, everyone's worried about the amount of new shares that they're adding each quarter. But if you're projecting your guidance based on EPS, that's accounting for the dilution. So they need to be certain on both. You know, you need to grow your net income, but you also need to make sure that you're not doing that through some sort of, you know.
Right. So if you look at all the dilution and the stock options and stuff that actually are diluted, but maybe won't hit, like say if no didn't hit any of his, and that's like 5 million shares, and I don't know how many of those PSUs are out there. You lose a lot of dilution. My only concern about, like I mentioned, dilution is the 2029 convertible debt is not included in fully diluted, because they made a statement that they intend to buy that back rather than issue shares. And so at some point, I think that the play would be that when these people convert, and or they have to pay for cash, they got to come up with the cash. But if you think about it, like somebody said, well, they need to go to a capital raise. They don't need to do a capital raise, but there might be an effective way to do a capital raise to pay off that convertible debt, either with another convertible debt that pays it off and you avoid the dilution, right? But you have more dilution than the next convertible, but that next convertible debt has a much higher convert price. So there's some funky things that they can actually do in 2028 to avoid a lot of that dilution. But it's not included. That dilution isn't included in their fully diluted numbers. So,
well, you know what they say, sales solves all problems. So you can kind of take care of those as long as you keep getting new members, selling more personal loans. A lot of those problems go away with some of their dilutive actions. So,
yeah, but that's a natural process of growing. I mean, you can see like Apple back in the day. Apple would get maybe not new investors, but they did get new capital from as a growing company. You get capital like why do people say that? Oh, this is the third tranche, the fourth tranche of raised capital. Fifth tranche is because you're growing so fast. I mean, you can even see this when you go to Shark Tank. They said, well, you need more capital to be able to grow faster and make more money. And that's true. People don't realize that. You need capital to grow. Well, the good thing about SoFi is they're building up their own capital. If you think like, okay, so what was it, $500 million income they had?
Last year?
2024?
Something like that. Well, I mean, especially if you include the
if you include that. But that goes straight to their capital base. So that's part of their capital.
Yeah, 498.6.
Yeah. So I'm not. If you looked at that fourth quarter report after guidance, you'd have to give it at least an A. People say the guidance screws you up, but I don't think the people understand the guidance. And the guidance issue, since this whole thing is about guidance, this whole podcast to some extent. It's 27 cents. It's after tax. The growth is 10%. They're going to make investments. He's not saying, well, we don't know where we're going to get the money from. Sales are going to slow down, or we're not going to have as many customers, or we have expenses that we didn't think about that wouldn't grow our revenue. I mean, if he says we're going to increase our expenses by, if he's saying like, say 30 cents was his guidance at 27, so we're going to increase our expenses by 150 million, and we're going to get another 500 million in revenue. That's not a bad thing to do.
Yeah.
It's so everybody's in a hurry. And I got to admit, I'm in a hurry. When the stock gets to 18, I have so many shares. It's like, okay, you get a Lambo, you get a Lambo. It's like everybody loves to see the value of their account go up. And the only problems I've ever had with that in buying stock is I've done that. I saw it. I go, I got to get that money. And then I looked like 2 years later and go, I should have never sold it. I should have kept it. I would have made a lot more money. But it's part of understanding the process of buying and selling stocks and what you want to do. And people have different uses for the money, and they have different goals for their stocks. I mean, so I can't fault somebody who says, I bought this at 6 and at 20 or 19, I'm going to sell it because, they might make, $25,000 and then they need to get their kid a car or put somebody through college or something like that. And so it's everything you make, everything you do in life with your money is an investment. And some investments don't pay off in cash; they pay off in different ways. And so, investing in your kids, investing in a nice place to live, investing in a car that makes you feel better about yourself. I mean, there's a lot of ways to invest your money.
What do you think about this comment here? Asked him about what a Trump tax cut would mean for SoFi, this potential change of federal corporate tax from, let's say, a 21% down to a 15% tax rate.
Well, it would jump their 27 cents to 30. So it would your tax rate goes down from 21% to 15%. That's 6% of 6% of 21 is like 2/7, whatever that is, almost 25% less tax. 6 cents is your tax. It's 1.5 cents to add to 27, 28.5, 29. Lowering corporate tax rates helps every company, and when you lower corporate tax rates, the market will adjust all the companies for that, right?
Yeah. Yeah,
and
that'll just be a good day to own the SPY as well.
yeah. I mean, I don't know if I told you this. I used to represent Trump. I represent him in a project in Los Angeles, so I've dealt with him a couple times. And everybody doesn't understand this. You can read his book, and then you'll understand it. That everything he says is the start of a negotiation. Because as a real estate developer and a builder, that's what you're dealing with unions. Everything's a negotiation, right? You don't, when you get a bid, you accept their bid, and then after the bid, you say, can you cut a little off here? Can you cut a little off there? Everything's a negotiation. So, like, will he really get no tax on Social Security, no tax on tips, and no tax on overtime? I probably don't think so. But he's generally more corporate friendly. So we'll have to see what happens. But any federal tax cut will help. And people ask me online once they said, well, why is it 26% if the federal rate's 21%? They go, well, you have state taxes in various states. And so people don't understand the state tax system is a lot more complicated than the federal tax system because for example, California will tax you on your whole corporate income worldwide, and then they'll allocate that to California based on payroll, property, and sales. And so your payroll is much higher in California. You have all the engineers up in Silicon Valley, that's much higher in California. You have property that your lease costs and building costs are way higher in California, and your sales are probably weighed more favorably California. So if they wanted to actually do something there in the 4 or 5% net state tax rate, they could save a couple percentage off by moving people different places. And so I said, yeah, you can move people to Utah and go to a 4% rate instead of that 8 or 10% rate. But do the engineers that you need really want to move to Utah? But there's all these issues that you could say you can do and not do, but there's always these practical limitations. And you want somebody in charge of the company that sees the practicality of stuff and does it. And I think Noto's that kind of guy. I think he sees the practicality of it. I mean, he showed you because he's like, I'm not, he could have easily said 29 cents, right? He could easily said the guide was 29 cents, but he's got to be conservative and say 27, and then I'll get you 32 or 31. I mean, it's like, it's just the nature of the beast, and that conservatism actually helps you unless you want the stock to go to 45 by March. But if you want to get the stock to go to 45 by March, that's really a personal, I won't say it's selfish, but it's your personal goal. It's not a company goal. They'd like to have it happen, but you have to have it happen not based on smoke and mirrors, but based on, substantial, sustained growth, right? So that's what when you invest, you want to see a company that has substantial, sustained growth, and then sees and looks ahead and builds out their businesses. Like if you had a contractor building your house and he comes, okay, we're going to do the plumbing, the electrical, and the framing all at the same time. You go, that's kind of a stupid way to build a house. And so when you're building a company, you're actually building like a house, right? It's really complex what you see at the end, but you start by building the foundation. Then you start by laying the concrete. Then you start by framing the house. You don't put the electrical in as your framing. You don't put the plumbing as your framing. What if you change some of the framing? See that if you analyze that to building a house, everything Noto's doing is making sense. Right? You don't do everything at once. You do you do the base items that can grow the fastest, and you add on to them, then you add on to them, then you bring something else in. He's building a house, right? And so when you think about good businesses, that's how they're built. Because when you make a mistake building a house, like I remodeled my house, it took me 4 years. People go, well, it took you 4 years. I go, yeah, but I didn't make any mistakes. The mistakes are what cost you. The change orders are what cost you. The not giving it enough critical thinking costs you. And so if you have somebody who's slower and more conservative, it's safer. It's not going to be built. The house is not going to be built as fast, but you're going to have a more solid house. And mistakes cost you money. And I think you can be overly conservative and avoid all mistakes. And then there's a happy medium of like, be a little less conservative, but still don't make the mistake. So I think he just somebody needs to push him and be a little more. He's getting better. He's getting much better in his earnings calls with enthusiasm, though. So you can tell he's enthusiastic. And so just get a little bit less conservative, a little bit less conservative. But he's the kind of guy that is not going to, he's the kind of guy that's not going to tell you the sun's going to come up until he sees part of the sun.
Yeah.
No,
I think constant higher than market growth, which I think SoFi will continue to hold up, is an amazing company to hold. I think everyone that wants the doubles every year, it's a little too much to ask for, and the companies that do promise that type of growth are way more risky than the objectives that SoFi is looking at going after.
right.
But there are some areas where I'd like SoFi to be a little bit more aggressive, because while trying to be conservative and not make mistakes, there's potential market share losses to be had as well. So
Well, it's all risk and
middle ground.
Yeah, it's all risk and return, right? I mean, it's like anything else. You can go to Vegas and you can see somebody win on a slot machine. Doesn't mean that you want to invest in slot machines. That was just happened to be their winning combination. There's companies that come out of nowhere. And you see, if people lived through 2000, you would see this with a lot of companies. You see the Amazon and Yahoo. And I forget the name of the company that was prior to Yahoo that had that business wired down, and everybody used it. I forget the name of it. Everybody used it in 2000. And it was
Mozilla?
like everybody, what?
Mozilla?
No,
Mosaic, and then it was Mozilla.
it was before them. I can't recall it, but I remember in 1996, when I first started at Deloitte,
AOL?
we came in, and no, it was AOL was before that, but this was like an AOL killer. I mean, you get all the information you wanted, and it was aggregated and everything else, and they just made a mistake because they tried to go too fast, and then Yahoo took over, and then it was Yahoo. And so
Netscape was another one. Yeah.
No, Netscape was a little bit before that, but I forget what it was. It was a data aggregating company like Yahoo does, like an internet company. You go to the internet, you go to their website, and I spent all night looking at this stuff because it was the first time I could get access to all kinds of research and information, and it aggregated it really well. And they just went out of business because you can see people that make mistakes that go out of business, and so you'd be a little bit more understanding of people who take it a little bit slower, I think.
Right.
But like I said, that being said, we can push him from a 10 conservative to a 9.2. Would be probably okay.
Yeah, no, I think that's a great point, Tim, and also a great place to wrap as well. I think we tried to wrap at an hour and then went an additional 20 minutes because you have a lot of great things to say.
All right. Well, I appreciate it. Just trying to help the people understand the stuff. So
you are an amazing asset to this SoFi cult, and
I'm beginning to think it is a cult. To tell you the truth.
Oh, it is. It is. But It's a great one, and so far so good. I mean, the linear growth on this company is crazy. I mean, it's up and to the right on their financials. The stock a little bit different, but that's what makes markets fun.
Yeah.
All right, ladies and gentlemen, thank you all so much for watching. Make sure you check out Tim on X. However, he doesn't actually do this for the following. You're going to want to do this for yourself. Make sure you give him a follow because he's sharing great knowledge on not only SoFi markets in general and his experiences in them. Tim, any last things to say? Any sign-offs?
No, I think that wraps it up. Just, stay tuned for what happens to SoFi the next year. I think it's going to be good.
Perfect. Thank you all so much for watching. Really do appreciate your time. But bye for now.